Hey there, class. My name is Sarah Garner, and today me and my partner Kimberly Seals are going to be presenting Chapter 13, Inventory Management Process. In today's presentation, we're going to go over 7 key topics: relationship the inventory management process has with other accounting processes, related documents and records, major functions, segregation of duties, control risk and test controls, auditing inventory, and lastly, a demonstration. So, what is the inventory management process? To explain it better, let's look at the 3 processes surrounding inventory management. The first is going to be your purchasing process. This process is basically whenever a firm purchases raw material and receives a payment of manufacturing overhead costs. Next, you have the human resource management process. This process deals with the assignment of direct and indirect labor costs. And then lastly, you have the revenue process, which is sale of goods. So again, to better understand the inventory management process, you have to look at the cradle to the grave cycle of how inventory begins and ends within a company. So whenever a company purchases raw materials in the purchasing process, then those raw materials are stored and managed, hence inventory management. Then, during that time that they're being stored, the human resource management process comes to existence by assigning the direct and indirect labor costs associated with those raw materials. Once labor or production takes place, then the raw materials become finished goods, and then this is where the revenue process comes in because the finished goods are then sold to the customer and essentially shipped from the warehouse. So once again, the inventory management process deals with inventory the second it arrives at the company to the moment it leaves the company and makes its way to the customer as a finished good. Now, let's review some of the related documents and records to the inventory management process. The first step is going to be the production schedule, which is typically prepared periodically based on the expected demand of the company's products. This production schedule usually determines the quantity of goods needed and the time it must be ready in order to meet the customer demand. Next, you have the receiving report, which records the receipt of goods from the vendors. The receiving report is actually part of the purchasing process. However, it deals with the inventory management process because a copy of it usually accompanies the goods to the inventory department, and the inventory department uses that copy to update the company's perpetual inventory records. Next, you have materials requisition, which is used to track materials during the production process. Typically, a copy of this may be maintained in the raw materials department, while another copy of this document accompanies the goods to the production department. After that, you have the inventory master file, which contains all information related to a company's inventory. And next, you have the production data information, which is typically common within manufacturing companies. So the production data information document typically has production information about the transfer of goods and related cost accumulation at each stage of production. And then next we have the inventory status report, which shows the type and amount of products on hand. Lastly, we have the shipping order, which is actually part of the revenue process. However, it's usually considered related to the inventory management process, since a copy of this document is used to remove goods from the company's perpetual inventory record systems. All right, next we have the major functions. So get this, this is actually quite a shocker. One of the most major functions of the inventory management process is inventory management itself. And get this, inventory management is basically managing inventory by planning and scheduling manufacturing activities. Next, you have the raw material stores, which deals with the receipt, custody, and issuance of raw materials. So essentially, once materials are received from vendors, they're then transferred to the receiving department, to the raw materials stores department. And once they hit the raw materials store department, it's that department's job to make sure that the materials are stored safely and they're safeguarded against any like pilferage or unauthorized use. Next, you have the manufacturing function, which is essentially in charge of producing the product. So from an auditing perspective, the manufacturing function should have adequate control over the physical flow of the goods, as well as proper accumulation of the cost attached to the inventory. To continue our major function slide, we have our finished goods stores, which stores and controls our finished goods. This is pretty much the same thing as raw material stores. Once the raw materials are transferred to the manufacturing function and completed, they're then transferred to the finished goods stores, and they're just basically safeguarded once again against any damage or unauthorized use. Next, you have cost accounting, which ensures costs are accurately attached to the inventory. Typically, cost accounting reviews the cost accumulation and variance reports by offering data that's processed into the accounting records. Lastly, you have the general ledger, which ensures inventory and cost of production are accurately accumulated, classified, and summarized in GL accounts. Typically, to ensure this function is being performed correctly, you can compare the control or summary totals within an IT system. Our textbook also references another important control performed by the general ledger, which is the reconciliation of the perpetual inventory records to the general ledger inventory account. All right, so for the inventory management process, the way segregation of duties should take place is that cost accounting or any individuals with cost accounting duties should be separate from having duties regarding inventory management, inventory stores, and the general ledger. The reason being is that if one individual is responsible for inventory management, but also has access to the cost accounting records, they can actually manipulate production and inventory costs, which can lead to an over or understatement regarding inventory and net income. And then if they have like the inventory stores duty as well as a cost accounting duty, then they can actually complete like unauthorized shipments, which can lead to theft of goods and be covered up. And then same thing as far as having general ledger and cost accounting duties. They can actually conceal the unauthorized shipments, which can again result in theft of goods or lead to an overstatement of inventory. And lastly, any individuals should not have the physical inventory supervision duty as well as inventory management or inventory stores duty, because it would be possible for them to cover up any adjustments of the inventory records, which again can result into the overstatement of inventory.
The three major steps in setting the control risk in the inventory management process is understanding and document internal control, plan and perform test of controls, and set and document the control risk. With understand and document the internal control, the auditor evaluates general IT controls and the inventory application controls. In the plan and perform test of control step, the auditor will identify relevant control activities. In the set and document control risk step, the auditor will use quantitative amounts or qualitative terms with supporting flowcharts or other documentation. The assertion of occurrence can have the possible misstatement of fictitious inventory. The assertion of completeness of the inventory transactions can have the possible misstatement of inventory being received but not recorded. The assertion of authorization can have the possible misstatement for unauthorized production. The assertion of accuracy can have the possible misstatement of the inventory quantities recorded incorrectly. The assertion of cutoff can have the possible misstatement of transactions being recorded in the wrong period. And the assertion of classification can have the possible misstatement of being not properly classified among raw materials, work in process, and finished goods. Substantive analytical procedures are useful audit tests for examining the reasonableness of inventory and cost of goods sold. Some preliminary procedures can effectively identify whether the inventory and cost of goods sold contain material misstatements. These procedures can also identify problems with improper inclusion or exclusion of cost and overhead. For the purpose of this demonstration, Sarah and I chose the assertion of authorization. The purpose is for all inventory transactions to be properly authorized. The audit procedure is to test a sample of inventory shipments. This is just an example. There are also other procedures that could test the assertion of authorization. So the evidence that the auditor would look for is that the shipments have approved shipping tickets. And this will prove if the materials are authorized to have been ordered and shipped.
This concludes our presentation. Thank you so much for watching.